Hi everyone, welcome to the 2012 Keystone Financial Services Halftime Report. This presentation was given live at Fort Collins Brewery on July 26, 2012. At Keystone Financial Services, our mission is to build high-trust relationships with our clients by providing exceptional service and unbiased financial advice in a caring, fun environment. We do this by knowing our clients and putting their interests first, limiting the number of clients we serve, and creating a culture of constant improvement. We have a full agenda today, and so we'll get right into our year-to-date market review. With all of the volatility, you might be surprised to know that stocks finished the first half of the year with gains both domestically and foreign. Let's take a look at some specific asset classes and see how they did. Domestic stocks, meaning U.S. companies, were up 8.3%. Foreign stocks, that would be companies based outside the U.S., up 1.1%. Gold up 1.5%, the dollar up 1.8%, and there were a number of goose eggs. The 10-year Treasury yield has dropped 8.3%, commodities down 3.7%, oil down 14%, and Spain, of course, one of the European culprits, is down 17.1%. The debt situation and concerns about the euro kept Europe in the spotlight in the first half of this year. It seemed like any announcement from the political establishment had the ability to move markets all around the world. So why is everybody watching Europe? 17 countries in Europe now share a common currency called the euro. It's brought many benefits to these countries in terms of trade and travel. However, it's also introduced some major fiscal imbalances between countries that are now playing out on the world stage. The problem is these countries share a currency, but their political and fiscal systems are still separate. So when one country gets in trouble like Greece, they lose the ability to use their currency as a tool to get their economy back on track. The potential end game is a centralized fiscal and political system in Europe, similar to what we have in the U.S., and Europe has been moving in this direction for decades. But now the situation is urgent. So the big question is, can Europe pull it together before the markets tear it apart? We're concerned about Europe because the Eurozone accounts for 13% of the global economy. If Europe catches a cold, the rest of the world probably will too. As you can see here, prior to the introduction of the euro, European interest rates were all over the map. As the euro was introduced, rates started to converge as the weaker countries started to benefit from the shared currency that was anchored by rock-solid Germany. This worked for about 10 years, and then we had the U.S. economic crisis that reached a climax with the Lehman Brothers bankruptcy. At that point, European finances started unraveling, and interest rates in several countries shot up. Now, it's clear that there are tremendous economic differences between the major European countries, and their interest rates are reflecting that. There's a huge difference in the size of the economy among the 17 countries sharing the euro. Germany is by far the largest, followed by France, Italy, and Spain. Notice that 5 countries have already sought a bailout, including Spain. The others include Greece, Portugal, Ireland, and Cyprus. Back here in the U.S., we've experienced growth since the depths of the economic crisis, but it has not been as fast as one would expect given the severity of the decline. Goldman Sachs now expects second quarter GDP to come in below 2%. That's about stall speed and not enough to make a significant dent in the unemployment rate. Now, turning to the unemployment situation, this chart shows how long it took the economy to recover all the jobs it lost in a recession. That bottom red line shows we are still a long way from recovering all the jobs we lost in the last recession. The other thing that's interesting about this chart is you look at the last 4 recessions we've had, 2007, 2001, 1990, and 1981, those 4 recessions have taken longer than all of the other ones before it. As far as the numbers go, we lost 8.9 million jobs in the recession, and so far have gained back 4.3 million. We still have a little more than halfway to go to get back to where we were. One interesting note here is that there are currently 3 million open jobs in the U.S. One factor is a skill mismatch among workers to what employers are looking for. Now let's take a look at what we're monitoring for the rest of the year. Corporate earnings, of course, are a key metric to monitor. We've had a huge increase in earnings growth since the 2009 low, and now growth is starting to moderate. This year, Zacks estimates earnings will grow by 9.6%. By contrast, earnings grew 15.2% last year and 44.9% in 2010. Next year, Zacks projects earnings will rise 12.4%. Of course, these are just estimates, and the actual numbers will likely be different. With all the money printing from central banks around the world, some folks are concerned about inflation. Here's a very long-term chart of the annual inflation rate. As you can see, the rate has fluctuated dramatically. Prior to the founding of the Federal Reserve in 1913, we had frequent bouts of deflation. Since the founding of the Fed, deflation has been rare except during the Great Depression. Currently, inflation is under control, but it bears close monitoring. From an annual peak of more than 1.3 million, new home sales, the red line, plunged to below 400,000. Recently, though, both existing home sales and new home sales have started to rebound. That's very good news for the economy. Small business owners are a very important part of the U.S. economy, and after having seen their confidence drop dramatically during the recession, it's now found its way back up to where it was in December of 2007. After peaking at 10% in October 2009, the unemployment rate has been improving. It's now down near 8%, but it still has a ways to go to return to those happy days of below 5%. A factor weighing on the market is what's been called the fiscal cliff. Because of existing laws, Congress has to take some action by the end of this year. If they don't, the following cuts and tax increases are scheduled to take place in 2013. First of all, some folks will lose their unemployment benefits. Secondly, the Budget Control Act cuts kick in. Third, payroll tax cuts expire, and the biggie, as you can see, sunset of Bush tax cuts. This isn't just a one-year thing. The spending cuts from the Budget Control Act would continue for 10 years and cut about $1.2 trillion from the federal budget. Nobody in Congress wants all these provisions to happen automatically, so expect to see some action at the end of this year, even if it's a temporary extension of some of the existing laws. So where does our money go? Nearly 70% of our federal budget goes to cover Medicare, Medicaid, Social Security, defense, and interest on the debt. Those items are hard to cut because they affect so many people, and that's one reason why we have big budget battles between Democrats and Republicans. On the other side of the equation, though, federal revenue only accounts for 68% of the government's total expenses. The remaining whole of 32% has to be borrowed, and that's why our federal debt keeps going up each year. Now, many of you know I like quotes, and this quote from William Feather, "A budget tells us what we can't afford, but it doesn't keep us from buying it." So, how does our current business environment fit within historical contexts? We think it's very important to have a historical perspective on the markets and the economy because it helps us place today's environment within the continuum of history. It helps us know if today's environment is an outlier that might revert to the mean, or if we're right about where we should be. There's a lot going on in this chart, and it points out several important points about the long-run nature of stock prices. The blue line represents the inflation-adjusted return of the S&P Composite Index for the past 140 years. As you can see, there are long periods of time when the market is moving up, staying flat, or moving down. The red line represents a regression to the trend line. You'll notice in 2000, at the peak of the stock market bubble, the market was about 155% above the regression trend line. That was nearly double the peak in 1929. There's an old Wall Street saying, "Don't fight the Fed." This chart shows you why. The green shaded area shows the time when the Fed was engaged in quantitative easing and doing the twist. The blue line represents the S&P 500 index. As you can see, the market was going up while the Fed was taking strong action to help the economy. Here are the first of four charts that visually show how we had such a strong stock market from 1982 to 2007 and why the markets and the economy are struggling now. We have to start with the consumer. Consumer spending accounts for about 70% of economic activity. Now, when consumers don't have enough money to buy everything they want to buy, what do? They borrow money. The blue line shows total consumer debt as a percentage of GDP. Notice there's a correlation between rising debt and rising stock markets. In particular, consumer debt started to take off in the early 1980s, and that coincided with one of the greatest bull markets in history. In the last couple of years, though, consumers have started to deleverage, meaning they're reducing their debt. That's why the blue line started to turn down. And as consumers cut back on spending, that slows the economy. Yet here's the ironic part. Even though consumers are cutting back on spending as a percentage of the economy, corporate profits have hit record highs as a percentage of GDP. These record profits are one reason why stock prices rose so strongly beginning in early 2009. But here's the question. How can corporate profits be hitting record highs when consumers are pulling back and unemployment is high? Well, for one reason, corporations have cut staff dramatically and many workers have simply left the workforce. This blue line shows employment as a percentage of the total population and is back down to where it was in the early 1980s. In other words, the percentage of our population that is working has dropped dramatically. With fewer workers, corporate expenses are lower and profits are higher. The second reason why corporate profits are so high is wages as a percentage of GDP are at an all-time low. Corporations have succeeded in lowering wages for many workers, and that's reflected in these numbers. In a nutshell, the economy is weak partly due to consumers deleveraging, but corporations are still showing record profits because they've cut staff and cut wages. So the big questions are, will the pendulum swing the other way, and when will consumers stop deleveraging and start borrowing again to power the economy? When that happens, you could see a huge lift in the economy and the markets. If you're looking for another reason to be bullish about the future of the U.S., these next two charts will help. Here we see 100 years of birth statistics. The red circles reflect the baby boom. When you lag that by about 35 years, you get the great stock market boom that began in the early 1980s. Births dropped off in the 1970s, but have since picked up dramatically and now rival the peak years of the baby boom. Although there are no guarantees, this bodes well for the future. And as compared to other countries, the U.S. is projected to see an increase of nearly 50 million working-age people between now and 2050. By contrast, other countries such as China, Germany, Russia, and Japan are all projected to experience declines. A growing working population is an important part of a growing economy, and the U.S. is in good shape for that to happen. And we also know that the ride in the financial markets is not always smooth. The green and orange bars show how many times the S&P 500 index has swung up or down by at least 2% in a day over the past 8 years. From 2004 to 2007, the number of swings was very small. Then, in 2008, the markets got really volatile and continued that way for the next 3 years. It's important to understand that swings of this nature, while not fun, are to be expected. We can't let them deter us from making sound, long-term investment decisions. As we wrap up, let's shift gears a bit and share a few words of wisdom from famous investors. One of the most famous investors of all time, Warren Buffett, says, "Look at market fluctuations as your friend, rather than your enemy. Profit from folly rather than participate in it." And as I showed you in the previous slide, market fluctuations have been happening with greater frequency lately. But like Buffett says, we can try to use those to our advantage, not our detriment. Sir John Templeton says, "In the stock market, the only way to get a bargain is to buy what most investors are selling." We all love bargains, right? Except in the stock market. When stocks crater, many investors get scared and bail out. However, if you own an effectively diversified portfolio, which we try to do, fluctuations in the market can have a lesser effect on the overall portfolio. Intellectually, that makes sense, but emotionally, it can be tough to implement. But that's why we're here. We help you make the tough decisions. We've covered a lot of ground here, and there are 3 key points I want to leave you with. First, deleveraging is a long, drawn-out process. We're still going through it, but once we get past this cleansing phase, it should set us up for the great boom ahead. Second, Europe is a wild card. If the euro falls apart and Europe descends into disarray, nobody knows what that means for the world economy. We think the chance of that happening is small, but not zero. Europe has too much to lose to let politics get in the way of decades of progress. Third, the U.S. is still a great country. Yes, we have our problems with budget deficits and squabbling politicians, but at the end of the day, the U.S. will find a way to come together and solve its problems. We have innovation, creativity, free enterprise, and demographics on our side, and that will propel us into the future. Thank you for attending. We appreciate your continued support, and if there's anything that we can do to help you improve, develop, or change your wealth management needs, please let us know.